Welcome back to the Chiro Money Show, where we help chiropractors make better financial decisions so they can build stability in their finances and a lifestyle they love. I'm Scott Campbell with Aligned Wealth. Chris is away still, enjoying some sunshine with his family in Mexico. But as they say, the show must go on, so a little solo pod action today. Going to dive in and do a little recap of 2025 in the markets. We'll talk about what did well, what didn't, but most importantly, what this means to you to help you put yourself in a position to make strong financial and investment decisions as a long-term investor as we head into 2026. As we will be talking a lot about investments today, you can't take any of this as personalized financial advice or recommendations on where to put your investment dollars. Please make sure that you're seeking out your own investment advice with your advisor and professionals before doing such. Before we jump in, I just want to say, if you've been a long-term listener of the show here, it's been 3-4 months now since we launched the podcast. We're 17, 18 episodes deep. We have a lot of fun putting the show on for you guys. If you've been listening for a while, thank you very much. I consider you a friend of the show. And being a good friend, if you could do us a favor, please, wherever you're listening to this podcast, if you can leave us a quick review, we would greatly appreciate it. And if you can do us one better than that, please share an episode that you found helpful in the past with a friend or a colleague. That's the best way that we can grow this podcast. It's really hard to actually grow a podcast organically, so we're relying on the good friends of the show to help us spread the word and grow the Chiro Money Show. So thanks again for being here. We appreciate you. So this was one of the wildest years in recent memory from, a broad economical investment standpoint. We had Trump move into office as president of the United States. And then a few months later, we started getting into the Canadian election. And that came with the same kind of time frame as tariffs and Liberation Day and trade wars. And then as we got through the year, there was tons of hype in the AI space and bubbles and you name it. Just a lot of headlines that were in my newsfeed, maybe not yours, but in mine throughout the course of the year. I just want to kind of dive in and keep this, again, high level. Let's keep it practical. Here's what you need to know. I think earlier in the year with everything that happened, there was a lot of pessimism. What was happening in the spring of 2025, which we'll get into. If you made your predictions of what 2025 would hold in terms of a return in your portfolio and whatnot, your predictions were probably far off, if I had to guess. So first and foremost, before we get into the single best performing asset class of 2025, which was kind of the headline here. Before we get into that, I think a few of the headliners that we wanted to touch on real quick was that if you weren't aware, there was a couple of asset classes within a broader asset class, that's commodities, that did exceptionally well in 2025. That's silver and gold. Silver had a return of somewhere around 130, 140% in 2025. Gold is around 70%, although I should note that here, just as we've gone through this last month, those have come back down. I think we're recording this on February 3rd. It was just Friday the other day that there was a major correction on both gold and silver. I think silver was down 30% in a single day. Bitcoin, we'll touch on that as well a little bit too. Heading into 2026, I think there was a lot of speculation that it was going to be a really great year for cryptocurrency with all the speculation around Trump being a very pro-cryptocurrency president and that Bitcoin was going to do all these wonderful things. I saw predictions out there that Bitcoin was going to reach $500,000 a Bitcoin by the end of the year. Well, in reality, got up to about 126,000 per Bitcoin back in October of 25, down to about 90,000 by the end of the year. So I think roughly flat, basically no return on Bitcoin, if anything, a little bit down over the course of 2025. And now here moving into 2026, Bitcoin's down even further. Last couple of days in general, it's been down quite a bit. So I won't get into the nitty gritty here about, the pros and cons to silver, gold, Bitcoin. Ultimately, if you felt strongly we're having a little bit of one of these types of assets in your overall portfolio, whether you have interest in gold and silver or you're interested in Bitcoin, it's a speculative asset at the end of the day. If there's a small portion of your portfolio that you want to have exposure to these assets, great. Should it be the primary or the base of your long-term investment portfolio? in our opinion, may not be the best long-term from a portfolio design standpoint. At the end of the day, there's a takeaway here when I see the headlines of like, I missed the boat here on getting in on silver and gold, like what a fantastic years that they had. At the end of the day, things like gold and silver, they have no intrinsic value. Like they don't produce anything. All you're really doing when you're buying an asset like Bitcoin or silver or gold is that you're hoping that when you buy it, that at some point in the future, be that in 6 months from now or in 5 years from now, 10 years from now, that someone's going to pay more for it than you did, right? It doesn't produce any sort of income or generate long-term capital appreciation, right? We talked about Buffett on the last show. I have to bring in one more quick Warren Buffett quote here and his stance on his perspective on gold anyways. He says this: an ounce of gold will still be an ounce of gold in 100 years. An acre of farmland will still be an acre of farmland in 100 years. The difference is that you got to use the land to grow crops and generate income during those 100 years. And I'll say this, the same thing if you owned Apple or Microsoft for 100 years in relation to owning gold. You're still going to have an ounce of gold in 100 years, but if you own a little bit of Apple or Microsoft for that type time frame, good chance that it's going to produce you, dividends and capital appreciation over that long period of time. So let's shift gears here and talk about what was the best performing asset class. If you take out silver and gold, which are really just, part of the broader asset class of commodities, the best performing asset class, and I'll say this, if you're in a well-balanced, globally diversified portfolio in 2025, you probably saw a pretty solid return in your portfolio. Emerging markets was the best performing asset class in 2025 with a total return of about 34%. Third best single year return in the last decade or so. Developed markets closely behind that at 27%. So that's all to say is that, basically I'll say this, after a decade, that's largely been dominated by the US, the S&P 500 in particular. 2025 was the first year since 2017 in which both developed international and emerging markets beat the S&P 500. I'm thinking back to the fall of 2025. I brought this up in an episode a long while back, having a conversation with a chiropractor who had, these concerns about where Canada was going with the upcoming election. And Trump came in and, he was dead set that I got to have all my exposure in the US. I think it's just a really great example of the importance of broad global diversification. We didn't go into the year expecting that Canada would have the year it did in 2025. The S&P 500 was at about 17.8% in relation to Canada, the TSX at 32%. Also important to note that real estate was the worst performing asset class of 2025 at about 3.3%. And when I say real estate, that's typically if you were to invest in what's referred to as REITs. It's REITs, real estate investment trusts. So it's basically an indirect way that you can buy little units of real estate globally. So again, global diversification is so essential. We can't let recency bias cloud our judgment in the way we're thinking about what could happen in the next years or decade ahead. All right, next I want to talk about an interesting day and period in 2025, and that was Liberation Day. Maybe some of you remember that. April 2nd, 2025, Trump announces sweeping tariffs. The market crashed hard in the following days. Over the course of 5 days following, the S&P 500 specifically was down about 21%. And by April 8th, was down 15% for the year. So a lot of panic at this time. I remember we had a few, not many, but a couple of clients reach out, just inquiring, heard the headlines, asking basically, is there anything that we need to do? Is there action that we need to take? Do we need to be concerned? And generally speaking, we've done a pretty good job at educating clients, as they get invested, as constant reminders of how and why they're invested, and to make sure that they're fully understanding that their volatility is to be expected, that corrections and even major crashes are to be expected. They're part of market cycles, and we've seen it over time with history, that this particular time in April was no different. And the best thing for us to do is to just stay in our seat at the end of the day. But what's interesting about that period of time is that, as I mentioned, April 8th, the market was down 15%, or the S&P anyways was down 15% for the year. April 9th, however, Trump pauses tariffs and markets surge 9.5% in one day. Huge or single digit 1-day return in the S&P 500. By May 13th, the S&P 500 was again positive for the year. And here's where it's interesting. By June 27th, new all-time highs. So from bottom in around April 8th, fast forward 12 weeks later, we're at all-time highs in the S&P 500, second fastest recovery period in the last 75 years. So why am I bringing this up? Here's the key behavioral lesson in my opinion. The market, again, is a device for transferring money from the inpatient to the patient. And April to June 2025 was a perfect example of that. Staying invested beats perfect market timing. And next bit that I wanted to get in here was this kind of was tied in from our current winter meetings that we're having with clients, where we take a moment to do a bit of a review of their portfolio, what happened in 2025, answer any questions that they have on investment philosophy and so on. We often hear sometimes, just invest into the S&P 500. You're going to get an average return of 10%. Just set it and forget it. It's really not that easy though. Here's what actually has happened over the last 99 years. So over the last 99 years in the S&P 500, the average return has been 10%. But what's interesting, over that 99-year period, there's only been 7 years within that stretch of time where the market came within 2 percentage points, plus or minus 10, so between 8 and 12% of that long-term average. We refer to that as the bumpy road to the long-term average. And I'm obviously, again, just speaking specifically to the S&P 500. This is a benchmark here. But what's interesting looking at history and these long-term averages is that over the last 10 years, the S&P 500 has had an average return of closer to 16%. So we thought it would be a good time. This could be a great, PSA for newer investors, and also a great reminder for long-term investors. If you're a brand new investor and you started investing in say 2023, you've seen some really strong returns in 23, 24, and 2025, and now even to the first month of 2026 as well. But they're much higher than what the long-term averages have been. So this isn't saying that we have any predictions of what's to come in 2026, but just looking back at history, we've been in this period of time where we've been kind of spoiled in some senses of really strong returns over this last decade or so, even more specifically over the last 3 years here, which it's great, but again, far off from the averages. The other area that we wanted to touch on, referencing Liberation Day here in April 2025, and how fast the recovery was of 12 weeks from market bottom back to all-time highs. This reminded me of a bit of COVID in March of 2020 when the market crashed. I think it was down around 30% over the course of 3 weeks, if I'm not mistaken, back in March of 2020. At that time, it only took about 5 months to get from the market bottom back to all-time highs. These are very quick recoveries. And if you look at history, these very fast recoveries, they're not normal. They're a lot faster than the average. And to give you some examples here historically, like the dot-com crash of 2000, for example, market crashed hard. It took 7 years for the market to recover and get back to a new all-time high. Financial crisis took 4 years to recover, right? I know we had a down year in 2022 as well. You might be thinking about that time frame. That recovery period took about 11 months. I don't have the specific number here of what the actual average has been over the long term. I just know that it's definitely been longer than a 12-week recovery or a 5-month recovery. It's just a reminder that not all recoveries are as fast as what they have been in recent years. To close out the show here today, just a couple action items that I'll leave you with to think about. If you're a DIYer, do your research. If you're working with an advisor, ask the right questions. 1, check your portfolio allocation. What percentage of your portfolio is made up in equities versus fixed income and bonds? Are you taking on the right risk based on your tolerance for risk and your time horizon, your capacity for risk? Are you invested in to 90% US because of recency bias of years and decades past? Questions to be thinking about as you move into the new year. Number 2, I think it's really important to have an investment strategy that you understand how and why you're invested. Ideally, you have your investment plan written down. At one point, you said, I'm going to invest this way for this reason, and this is my philosophy around investing. Is it a sensible approach to investing? I think when you go through that process, when volatility inevitably hits, there's a much higher likelihood that you're going to stay the course. Last little quick action item that I'll leave you with here too, and a great reminder from 2025 is you just have to ignore the noise. Tariff threats, political drama, recession predictions, all the AI hype and crypto hype, all that noise just won't matter in 10 years. Makes us feel like we need to take action in the moment. But the most sensible approach from what history has shown us is that we got to tune that out, just stay in our seat and give us, as we mentioned earlier in the show, it's all about time in the market. It's not trying to time the market based on these headlines. So I will leave it there for today. Thank you again for tuning in. Appreciate you, and we will see you again next week. All opinions expressed on the Cairo Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.